naturally you do have a from 7.2 to 7, and therefore you have a slight advantage of the base effect that is coming in there as well. And if I look at the next slide, the agriculture sector in FY24, as you might have seen from the data for the first 9 months, obviously has been somewhat lackluster because we had an erratic monsoon. Kharif harvest is on the lower side. But the good news is that the Rabi sowing has been quite good compared to last year. It's flat. And the predictions of withdrawal of El Nino also make the case for a normal monsoon in the next calendar year, as well as good harvest both for Kharif and Rabi crop next year. So in that sense, agricultural sector value added should rebound in FY25, and that would naturally boost rural incomes as well. Private consumption share of GDP has come down, which is understandable after the big jump in the previous financial year, and also other sectors of the economy are now picking up. For example, the gross fixed capital formation. So the slight reduction from 58% to 55% plus of GDP for private final consumption expenditure is not a sign of distress or slowdown, but is also a reflection of the demand growth in the economy being more evenly distributed than before. So I have already spoken to you about the 8.4% projection for the estimate for the fiscal third quarter. So I will move on from this slide to the next slide. What you see here is, of course, India's GDP growth numbers continue to outstrip the growth rates that we are seeing in several other economies around the world. And we have talked about it many a time in the past. I'll repeat it. Those who are not speaking, could you please mute your lines? Those who are not speaking, please mute your lines.
Somebody's TV is switched on.
If somebody has a TV on, they can choose whether to watch the TV or listen to the press conference. Could you please mute those volume indicators, please? Thank you. India continues to be an outlier, and we have mentioned the reasons for it in the past. It is because of the ability to withdraw the COVID stimulus, and also by keeping therefore creating fiscal space, and also making sure, I think the external noise is still coming, please. Can you please mute those lines?
Please, whoever has got their TV switched on, please switch off your TVs while the briefing is on. Any other device which is on and whose volume is on, please switch it off.
So the reason for Indian performance continuing to do better is because of the COVID management, as well as the emphasis on capital investment, which has now begun to crowd in private sector as well. Industrial sector growth, as I mentioned earlier, has picked up quite well. You can see it in the gross value added sectoral growth breakdown as well. Mining, manufacturing, construction sectors. Could you please mute your lines? There is a lot of ambient noise. Can you please help by muting your lines?
This is Oct-Dec and BTTV. Please mute your mics. Oct-Dec and BTTV.
Mining, manufacturing, and thank you. Mining, manufacturing, and construction sectors gross value added. You can see that both in nominal terms and in real terms have done quite well. Of course, if you look at the growth rate in the first 9 months of GVA in these sectors, real growth is higher than nominal growth because they are usually deflated by the wholesale price index, which has been negative this year in terms of the year-on-year change for the FY24, and that is the reason why the real growth rates are higher than nominal growth rates. That said, even the nominal growth rates show a good recovery in these sectors compared to Hello, can you please help me by muting your lines? Hello. So industrial growth rate has now picked up. That's why I said there is a better balance of growth, and I already walked you through the reasons why agricultural sector's gross value addition is lackluster, but I expect a recovery next year. And the economy macro vulnerability index, which you have prepared, and the details are given below. The macro vulnerability index is actually trending down, which is as it should be when the macro vulnerability index goes down. It did pick up in the years leading up to the pandemic, and now it is on its way down, which is a good sign that the overall macro economy is displaying stability, because it is calculated by a simple combination of fiscal deficit, current account deficit, and retail inflation. This is also shown in the macro uncertainty index for the Indian economy. And if I look at the agricultural sector performance, we have talked about it earlier already, so I'm not going to go into the details. I've given you my explanations for the tepid performance this year and the reasons for the recovery next year. In terms of industrial growth, as one would expect, as the private sector investment begins to rise, and as the rising incomes and consumption recovery in general spilling over from last year to this year is also now crowding in production. We can see that in the continued ebullience in the purchasing managers index, IIP growth rates, and increase in cement production and steel consumption, and also in the steady pickup in the railway freight traffic growth as well. In terms of the services sector, although once again the hospitality sectors show a slightly lower growth in the current financial year's 9 months compared to the previous year, we must remember that it is coming off a very strong recovery in FY22 and FY23. It is more a sign of stabilization rather than any underlying weakness at the moment. Purchasing managers index in the services sector is doing even better than the manufacturing sector. Digital transaction volumes and foreign tourist arrivals are now appreciably above the pre-pandemic average. And in terms of the revenue per available room is rising, and the overall daily rate is also picking up, so indicating good business and leisure travel in the country. Urban demand conditions, whether you look at passenger vehicle sales or domestic air passenger traffic, overall consumer confidence, and as I mentioned earlier, construction sector recovery is also evident in the housing sales. Now, there is always a question mark in people's minds, notwithstanding evidence. People tend to go by their perception, but the rural demand, as you can see on the top left, volume growth in rural fast-moving consumer goods has been rising for 4 consecutive quarters, starting from Q4 of the last financial year. And both 2- and 3-wheeler sales are on a rising trajectory. Increase in tractor sales we have seen in January over December, and in general in the current financial year we are seeing tractor sales doing quite well. But as I mentioned earlier, with the anticipated better value addition in the farm sector next financial year, rural demand growth and rural income growth will be even better and more evident in FY25. And then if you look at the household monthly personal consumption expenditure, we can see here compared to the 10 years ago when we had the household consumption expenditure survey, we can see the big recovery in the overall consumption spending in rural India and urban India. And many news reports have shown how the share of food expenditure has come down in both rural and urban India, giving them more space for discretionary expenditure, and how much of the expenditure growth has happened in the lower fractiles rather than in the higher fractiles. So in general, the story is one of rising purchasing power and reduction in the poverty headcount ratio, as well as a better distribution of consuming power in the hands of the population, more so in rural India than in urban India. Now, moving on to the inflation data, food inflation has been volatile, but we must remember food as a share of expenditure is coming down, and the bottom income segments of the population are shielded by the food price inflation by the government's Pradhan Mantri Garib Kalyan Anna Yojana program, which is now extended for 5 more years. So in some sense, the food inflation as measured by the data is not exactly the food inflation that the actual consumer faces, because many of them do get at least certain quantities of food items for free. So in that sense, the food inflation does overstate the impact on the consumer wallet. Stable food prices assisting in lower inflation. WPI inflation has entered positive territory now. That is why you are seeing it in the recovery in nominal GDP growth numbers now at 9.1%. Inflation expectations remain stable to slightly lower. In fact, the current perception is quite low, and the 1 year ahead perception has remained slightly lower but stable. Global demand has been a challenge given uncertain global growth. Many regions of the world, Europe and East Asia, are showing moderate growth, and therefore overall export growth performance has been middling at best. But nonetheless, due to the decline in prices of manufactured imports and also decline in services imports, the overall service sector surplus is quite good, and the overall trade balance, the deficit, is shrinking. So the external sector is showing no signs of vulnerability despite the poor performance of exports in general because of global demand conditions. We must also note that, however, remittances by Indians went to achieve a record in 2023 and will do so, expected to do so again in calendar year 2024. I just spoke to you about the external sector being stable. Current account deficit is heading towards just 1% of GDP. And the forex reserves now cover about 11 months of imports, and FPI flows are at $33 billion. We should also note that the gross FDI inflows into India are doing quite well compared to the last financial year in the first 10 months of the current financial year. The net FDI flows, after we take into account repatriation, is lower. But then repatriation arises on account of investments made at any time in the past. They do not reflect the current sentiment. And sometimes repatriation also happens when the investment has been extremely profitable, and as the underlying investment goes public, that investment is picked up by portfolio investors. So in that sense, focusing on gross FDI to gauge foreign investor interest in India is more appropriate, because repatriation doesn't pertain only to the current financial year, but it could be arising on account of investments made at any time in the past. Government's commitment towards fiscal management is evident in the fiscal deficit as a percentage of RE in the first 10 months of the year, and also in the tax collections, as well as in the continued steady increase in the average monthly GST collections as well. If you look at the quality of expenditure, year-on-year growth in capex in the first 10 months compared to year-on-year growth in revenue expenditure, and the overall decline in revenue to capital outlay ratio by more than half, 7.5 to 3.7 times the ratio, shows continued emphasis on capex and continued monitoring of the quality of fiscal expenditure on an ongoing basis. Private sector investment activity is evident in micro data as well as in aggregate data. Import of capital goods, increased production of infrastructure and capital goods, and expansion in the capacity utilization in the manufacturing sector, and more importantly, in the actual data of investment by private non-financial corporations. From around 4.6 trillion rupees in FY19, we did face a dip in the next 2 financial years. But however, the recovery since then has been quite significant and fast in terms of ramp up. So we have said it many times, private sector capital formation is not a story for the future. It is a story that is unfolding as we speak, and we expect it to sustain on the back of the improvement in infrastructure facilities, and also with respect to reasonable tax rates, reasonable interest rates, and a continued nurturing policy environment for investments in general, not just foreign, but also domestic. As you are seeing in the data, on the first 6 months of the current financial year, running at 3.4 lakh crores compared to 3.1 lakh crores in the last financial year. This is based on data pertaining to over 3,300 companies in the private sector. Banking sector story is well known. At the same time, we are also aware that both the government and the central bank are focused on ensuring that banking sector remains viable and healthy for a much longer period than we enjoyed in the previous cycle, so that we don't repeat the mistakes of the previous cycle when there was excessive and rapid growth in credit burning out very quickly. So that is why I think the growth in non-food credit is moderating, excluding personal loans at 15%. And banks also are beginning to place more emphasis on deposit mobilization so that the credit to deposit ratio remains at reasonable level rather than being excessive. Urban employment indicators are continuing to decline, and net payroll additions under EPFO, even though there was a slight slowdown in the months of September to November, once again picked up quite strongly in the month of December, as we can see in the data. Overall, general government spending, none of this is actually coming at the expense of the government's attention to the social sector. If anything, the macroeconomic data reveal the success of the two-pillar approach of the government towards economy in general. One is economic growth through infrastructure and public investment, and inclusion through empowerment. These two pillars have defined the macroeconomic policy landscape, contributing to a much robust recovery in India compared to other nations post-COVID. And you can see that in the overall quality of general government spending, which includes state governments as well. As a percentage of total expenditure, it has gone from a low of around 23% to near 26% in the last 3 years. And the numbers in absolute terms has also been rising very steadily, from just under 10 lakh crores to over 20 lakh crores just in the last 8 years. Overall, we believe that given the prospects of a normal monsoon, good Rabi sowing, prospects for rural income growth, and pickup in manufacturing and mining sector growth, and a pickup in bank credit growth, which has been unfolding. So overall, the Indian economy ticks many boxes in the right way, continuing to grow at around 7%. And now, if there are question marks that are coming, they are coming from the external world because of the continued geopolitical uncertainty and moderate to slower economic growth elsewhere. Possible other repercussions may also come in terms of global risk aversion if the financial market exuberance in the developed world gives way to more realistic expectations of earnings growth. And as we know very well, it is a year of elections, not just in India, but in several parts of the world, and outcomes so far have been somewhat unexpected in several countries in the world, and those in turn have imposed their own uncertainties on their macroeconomic policy framework and growth prospects. So these are the external risk factors that we have to bear in mind. And the ongoing risk factor is, of course, the challenge of managing energy security and energy transition, which India has been able to handle quite well compared to others. We are continuing to secure energy for Indian households and businesses because power cuts are a thing of the past, and there is a national grid, and grid stability is being ensured even as the country continues to increase the share of non-fossil fuels in its overall installed capacity. But nonetheless, that is a medium-term challenge which we face. So as you can see on this slide, high frequency indicators point to continued good performance in the fourth quarter of the current financial year. Most indicators are either yellow or green rather than red, and that is a good sign for the growth momentum to continue. And based on the projections for FY24, which is now the MOSPI is showing at 7.6%. This has been the projections made by several other international organizations. So the actual performance of the economy has continued to defy expectations and do better than what many had projected, underscoring the fact that a structural transformation of the economy is indeed underway, both in terms of physical infrastructure and digital infrastructure, as well as inclusion agenda, boosting the purchasing power of Indian households, which we saw in the household consumption expenditure survey data as well. So there is a case for many agencies to reappraise their estimate of potential GDP growth in India to closer to 7%, if not above. And let's also remember that the central bank, Reserve Bank of India, is projecting 7% GDP growth for FY25 as well. Thank you very much, and I'm open to questions.
Hello and welcome to NDTV Profit. I am Vikas Srivastava. We have with us Mr. Harsh Mariwala, a man who needs no introduction, but just for the sake of familiarity, he is the founder chairman of Marico Group, which is one of India's largest FMCG firm. He is also the chairman of India's Marico Group's foundation, which is fostering incubation of startups in the country by creation of waste reduction as well as creation of recyclable products. Mr. Mariwala will today talk to us and take us through this initiative as well as about their growth plans. Welcome to NDTV Profit.
Thank you very much for calling me.
Mr. Mariwala, we have got to know about this new initiative that you all have started.
Yes.
There are some close to 9 startups that you are working with.
Yes.
So how this entire initiative going to help the Marico Group's green agenda, going ahead?
So we are talking about the plastics report, which we had launched, I think, 1.5 years back. And the whole objective for launching that was that, plastics has a big issue in terms of its impact on the environment.
Right.
And can we do something to reduce that? Marico uses a lot of plastics, and luckily 94% of the plastics we use are recyclable. But nonetheless, whenever I spoke at an event, one of the first things which was asked to me was, but what are you doing about the plastics which you are using for packing your products? And when the team came back to me and said that can we do something about this larger issue of plastics and its impact on the environment, we said that can we commission a study of innovators who have products or machinery which can help us alleviate the problem. And that's how we tied up with Indian Institute of Science and Praxis Consulting and came out with a report which identified 14 innovators who are doing innovative work in this area.
Okay. And if I can ask, what exactly is the process? Do these innovators or these startups?
So these are very diversified innovators. So some of them are replacing plastics grown out of seaweed from bamboo shoots.
Okay.
Some of them are helping us recycling plastics, like